Hey everyone, welcome to this edition of Money Matters with FSA. I'm Mike Zarelli, certified financial planner, and today I've got 5 tax tips for you to review before the end of the year. Let's jump right in. First up is going to be know your contribution deadline. Now, there's different types of accounts that you can contribute that will impact your bottom line when it comes to tax time. But they have different deadlines, so it's important to know which one you're facing up against. Most accounts like 401ks, 403bs, and other retirement plans, if you're a W-2 employee, December 31st, that is your hard and fast deadline. Whereas other accounts like an IRA, Roth IRA, or HSAs, they actually have until your tax filing deadline, typically April 15th, to make those contributions. Now, if you're a business owner and for example, you're a sole proprietor and you have a solo 401k, you're on your own rules. You can wait up till your business tax filing deadline to make those contributions. So bottom line, know your contribution deadlines so you can determine how much you need to contribute to either lessen your tax burden or accomplish those long-term goals. Next up is going to be Roth conversions. This topic has been pretty hot in recent years, and so it's kind of one of those top tips. Regardless if it makes sense for you or not, running the numbers to double check the math, it really makes sense. Because what we're trying to accomplish here is to lower your lifetime tax bill, taking a long time view. So that may mean paying more taxes now to smooth out your tax hit later. Let me give you an example. As you may know, our tax system is progressive, meaning it's kind of like a stair step up where some money gets taxed here at the 10%, then some money here at the 12%, then some money here at the 22%. And the key thing is only what's up and above that stair step gets taxed at that level. So if your marginal federal tax bracket is at the 22%, not all of your income is being taxed at that level. Now, however, if the 22% tax bracket is pretty low for you, and you expect to be in the 24 or the 32 or the 36% tax bracket later down the road, maybe it makes sense to speed up your income by taking money out of your IRA, pay the taxes now at the 22%, and convert it over to a Roth for tax-free growth. Now that's a pretty high level and complex strategy, so I definitely recommend working with some professionals, maybe a tax preparer, a CPA, an advisor, to help you run the numbers. But if you add the tax savings plus that tax-free growth, the compound growth of decades of growing the money, this can be a slam dunk strategy. Next up, we have tax loss harvesting. Now, it's been a great year in the market, so there may not be too many losers in your portfolio, but now is a great time to double check, see if you can turn those losers, some stocks that maybe didn't turn out too well, and reap the benefit of taking those losses to offset some gains. As you may know, you can take capital losses and offset capital gains to negate the impact on your tax bill. And what's really cool is if you have more losses than gains, you can actually subtract up to $3,000 of your income in the current year. And this tax loss that you've harvested, if you have more than you can take out on one single year, you can carry it forward to the next year. Again, maybe not too many losers right now. One other key thing to keep in mind, this only works for taxable accounts, so non-retirement accounts, but something very cool to look at that may be able to reduce your tax bill. Next up is going to be how to get you over that standard deduction hump. For those that file married filing jointly, the standard deduction is now $29,200. So it's pretty difficult to get over that, to have enough itemized deductions to get over that hump. And the typical ones are going to be your mortgage interest, the state and local taxes, charitable contributions. The one I want to talk about is the charitable giving contributions. One idea or one method is to double up in a certain year and then skip the next, or vice versa. Skip this year and then double up next year. And the way this works is that let's say that you're short of the standard deduction by $5,000, but you give $5,000 annually to charities. Well, what you could do is skip 2024, that contribution, and then in January, make the $5,000 contribution, and then in December, do your 2025 contribution. Now you have $10,000 of charitable giving that you can use as an itemized deduction to hopefully get you over that standard deduction hump. Now, this other one is going to be for certain folks. This is the inherited IRA rules. As many of you know, the rules have changed recently for inherited IRAs. It's no longer that you get to take the money out over the rest of your lifetime. Now you have 10 years to take out the money. And to complicate things a little more, starting in 2025, there's a little required minimum distribution that you have to take out. Either way, work with a tax preparer or an advisor to determine when to take that income. In a year where you have less income, let's say you switch jobs, you didn't have income for a month, maybe it makes sense to take out more money in that year and then less while you have that higher income. Or maybe you're about to retire, you're 5 years away from retiring. So you'll take out just the minimum distribution there. And then when your income turns off, then you start taking out bigger chunks to fill up those lower income tax brackets. Now, of course, I'm not gonna leave you without a bonus tip. And this bonus tip is to make sure that you're withholding enough through your paychecks, distributions from IRAs, pensions, annuities, all the types of incomes that allow you to withhold, maybe estimated tax payments, because you don't want to pay penalties and interests to the IRS or your state government. So the key is you want to pay at least 90% of your current year, so 2024 tax bill, or as a safeguard, you could do 100% of your 2023 tax bill. If you make over $150,000 of your gross income, then it's 110% of last year's tax bill. We always say, tip your servers, not the IRS. With that, that wraps up these 6 tax tips. Again, working with some professionals to help with your tax burden can make a lot of sense. If you have any questions, reach out to questions@fsainvest.com or give us a call at 301-949-7300. See you in the next video.